Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, this week's show, the question really is speculation driving the market? And I'll come on to why that is the lead theme on this week's show. But it's been about 2 weeks since the last show. And since then, if we go back and look at the market and how it's performed, we've had the FTSE 100 move from 6160 2 weeks ago to almost bang on 6160 this week. But it's been a lot of deviation in between that. So there's been some strong rallies, there's been some strong pullbacks. Fundamentally, the market is still where it was last week, despite this ride up and down. If you look at the S&P 500 2 weeks ago, it was around 3,076. As I look now, the market is higher in the US, which is at 3,169 on the S&P 500. The VIX, the fear index, was at 33 a couple of weeks ago. It is now around about 28, so it's slightly lower, suggesting there's a little bit less fear. But the 10-year US Treasury yield was at 0.72 a couple of weeks ago, and now as I look, it's around about 0.66. So if you look at that, that gives you a bit of a snapshot of what's happening in markets. The US market has continued to try and grind higher, but it's still stuck in that range, which is between its 200-day moving average, which is now around about 3,024, and 3,250. So it keeps rallying up to those levels and pulling back. So we're still having that box type range bound trading in US equities. In the rest of the world, we're seeing the market largely remain fairly flat, particularly in the UK. Despite those rallies and pullbacks, the market still hasn't really gone anywhere. And it's almost like it's looking for a catalyst to break higher or lower. Now, if you dig below the surface, the US tech stocks have been pushing to new all-time highs. So if you look at the NASDAQ composite, we've been seeing new all-time highs on that the last few weeks. That continues to be the case. In fact, it's not unusual now to just see the NASDAQ be the only US stock market that's pushing higher day upon day, while the wider S&P 500 or the Dow Jones actually has a down day, or even the rest of the world has a down day. We're seeing something very similar again today. So the message is what it has been throughout much of June as we move into July, is the US tech stock market sector is the place to be. And I mentioned last time about the Robin Hood investors that were being blamed for pushing things much higher. So they were speculating in those stocks that were unloved, like airlines, that perhaps they could make a quick buck on, but also some of the tech stocks, those growth orientated stocks, the stocks that they quite liked. And the reality is that technology stocks have taken on a slightly peculiar trait in this coronavirus world. So previously they were very much a growth story. Then when we had downturns, they could quite aggressively pull back as people moved into defensive sectors like consumer staples, for example. But what we're seeing in the coronavirus world is that tech stocks are almost behaving like defensive sectors themselves. So they're almost like the new defensive. And that's in part because when we've had the lockdowns and the work from home scenarios, things like Amazon have done incredibly well because they've been able to take a significant market share just because most other retailers offline are shut and they're able to still operate. You've seen the likes of Zoom do incredibly well. Obviously, some of the social media outlets, Facebook has taken a bit of a hit because of the companies pulling their advertising from that particular platform, but generally tech stocks have been quite buoyant. So it's playing into that theme. And so it means that the market in US tech stocks is being pushed higher and higher. So on a day when there is a lot of risk appetite, they're being pushed higher. And on a day when people are feeling worried about the coronavirus and new outbreaks or spikes in the number of cases, they might be moving towards assets they think can do better, i.e. be a little bit more defensive in that scenario. And that's also tech stock. So the real question is, can this last? Because things look pretty stretched right now. And in the last episode of this show, I started to ask the question about breadth and whether breadth would improve, because we saw the market rally, so the wider market. Let's take the S&P 500, for example. And it had rallied very strongly from the lows in March. And the breadth, so that's a number of stocks that are above their 200-day moving average, was improving all the time, which is what you want to see if a rally is to be sustainable. But we've got to the point where this is stalled. The breadth isn't improving as quickly. So that raises concerns about how long the market can keep pushing higher just off the back of a limited range of stocks. And that's particularly stocks, the US technology stocks that I mentioned. Now, June brought to a close the end of a very profitable quarter for investors. In fact, you would have seen stats like it's the best quarter for the S&P 500 since 1988, the best for the FTSE 100 since 2010, and even gold. It was one of the best quarters since 2016. But this obviously masks one of the quickest bear market falls in history. So we saw the market collapse at the end of February into March. So a lot of markets still aren't back above their February highs. The NASDAQ composite is, so anything related to tech is pushing to new all-time highs. And the wider market hasn't quite caught up just yet. And it certainly hasn't if we go outside of US stocks and outside of US tech stocks in particular, we look at the FTSE 100 or European stocks. So we still are way below those all-time highs for all of those markets. But what worked in June has been what's really worked for the whole of 2020 to date. So that means government bonds, US treasuries or gilts, they continue to push to new highs. That means their yields have been pushing or trying to push to new lows. Gold has done very well. So we're seeing gold up to $1,800 an ounce. And the price is now at an 8-year high. And we keep seeing it push higher. Now, it's at a crucial point because at that level, if we can sustain that break above the $1,800 level, then there's every chance we could see it move towards 2,000. Of course, gold is very volatile. It has, it almost operates like an equity in terms of volatility. But as part of our portfolio, it's a very good diversifier. And in fact, some research I did for 80/20 investors in the last week showed the benefits of holding a small amount of gold in your portfolio throughout the sell-off that happened in February and March. So holding gold and bonds did well in June. It's done well the whole of 2020. And of course, being focused on US technology stocks has been the best play of 2020 and, as I say, of June. So going forward, we'd like to see whether these continue, these trends actually keep pushing higher. It has meant that you can have a very narrow portfolio, and almost in some ways, the more narrow your portfolio has been, you would have benefited from these trends to a greater extent. Now, if you take my own 50k portfolio, which I run on 80/20 Investor, it has a much more limited equity exposure at the moment. So we've only had in recent weeks between sort of 40 and just over 50% equity exposure, but it has performed very well and outperformed professionally managed portfolios with over 80% equity components and exposure, even during a month where equity markets have rallied because of this exposure to other assets, but also because of the exposure to US technology stocks in particular, which have done very well. So commodities have been the other place that have done well. So it's not just gold. I mean, gold is one of the main commodities that people think of, but it's also because the dollar is weakening. Any environment where you see the dollar weaken is very good generally for commodities, and it's also generally good for emerging market equities as well. Now, you will also notice the pound has been rallying against the dollar. You can see that we're at now about $1.25 as I make this show. So it's been pushing higher again. We're at a level that's crucial. Actually, it's just gone to $1.26. Whether we can push up towards that $1.30 level or whether the reverses and we get a bout of panic buying of the dollar in case of a bout of market fear, then we might see that pattern reverse and head towards $1.22 again. But it's an interesting one to watch. Now, I mentioned emerging market equities. Now, Chinese equities have been another asset class that has performed very well in 2020. Of course, there was a bit of a pullback when they suffered their coronavirus dip earlier in the year, but they have rebounded. And in fact, Chinese equities in the last week or so have almost gone parabolic. Go and get your stock market app on your phone. Go and look at the CSI 300. You can tap that into your app and then have a look at the performance in the last month to 3 months. And you will see that the market has gone almost parabolic in the last sort of week or so. And that is an element of speculation we're seeing. So you remember we talked about speculation among Robin Hood traders in America. 80-20 investors would have seen that I likened it to what happened in Chinese equities in 2015, which ultimately ended very badly. We are now starting to see almost a repeat of 2015, potentially in Chinese equities again now, as people are speculating heavily, so retail investors. And part of that has been because Chinese owned media has been encouraging people to do so. So that's why we saw one of the biggest one-day gains in over a year on Chinese equities this week. So keep an eye on that. That would be very interesting to see how that unfolds. But if you look on that app at the CSI 300, you might have to go and find one of the other trackers on there rather than just the index. They have a longer time period. If you have a look, you can go back 5, 6, 7, 10 years and you will see the difference in where we are now compared to what happened in 2015. So to give you some context about where the market could potentially go. So when it comes to what to look out for in the days and weeks ahead, the trade war is still in the background. The coronavirus is still an issue. One of the biggest things is just central bank liquidity. It's one of the biggest drivers, if not the biggest driver of markets right now. As long as the central banks out there keep pumping money, the market seems to only want to go higher when they do so. So if they start to turn off the taps, the liquidity taps, then we are in trouble. But also governments with their fiscal stimulus, so actually providing tax breaks and loans, etc., to try and boost the economy. If we see lots more of that, then that will be good news for stock markets. Also, next week is the start of earnings week. So companies will start announcing their earnings results for the second quarter of 2020. And that crucially is the period across which most countries experience some form of lockdown. So we'll get more insight into what's really going on in the economy, and it'll be interesting to see how the stock market reacts to that, and also bond markets as well, because we could get some possible signs of future defaults on loans. But look at the stock market, see how it reacts. It could get quite volatile, but it also could be a catalyst for the market to break higher or lower. But as the title suggests of the show, speculation appears to be driving at least part or some corners of the market. Now, that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien at moneytothemasses.com is the email address. Twitter, money to the masses with the number 2. Instagram and Facebook. Our Facebook group you can find at facebook.com/groups/money to the masses. And we've just crossed the 2,000 member level, which is fantastic. So make sure you come and join us. And of course, don't forget to subscribe to our YouTube channel.